All right, welcome. Today, we're going to demystify one of the most foundational parts of the entire financial world, bonds. Forget all the jargon and the complexity for a minute. We're going to break this down with the kind of clarity you'd expect in a consultant's briefing. The goal here is to give you the real tools to understand how this multi-trillion-dollar market actually works.
So, before we dive deep, let's just start at the top, the executive summary, right? If you can get your head around these three core principles, you'll have the framework for everything else we talk about. First, a bond at its heart is just a loan. You're the lender. Second, its price moves in the opposite direction of interest rates. This is the crucial dynamic, and we'll really dig into it. And third, every bond has an expiration date, a point where the original loan gets paid back in full. Master these three ideas, and you've got the foundation.
Okay, so here's the game plan for today. We'll kick things off with the fundamental concept. Then we'll dissect the components of a bond piece by piece. After that, we'll map out the entire bond universe, tackle that critical relationship between price and interest rates, and finally, we'll look at how you can actually invest in them. It's a really logical flow, from the what all the way to the how.
All right, first up, what is a bond, really? The simplest, most powerful way to think about it is this. When you buy a bond, you are the lender. You are the bank.
It's really just a formal IOU. Big corporations and governments, they issue these things to raise money for huge projects. We're talking funding new highways, building schools, or financing brand new research. So in exchange for your loan, they promise to pay you regular, fixed interest payments, and then on a specific date in the future, they give you your original money back.
Okay, so we've established a bond is just a loan. Now let's pop the hood and look at its anatomy. What's interesting is that every single bond, it doesn't matter if it's from a tech giant or a small town, is built from the exact same 5 core components.
You're going to see these 5 building blocks on every bond. The face value, that's the loan principal, the amount you get back when it's all said and done. The coupon rate, that's your reward, the interest you're earning for lending out your cash. Coupon dates are just what they sound like, your paydays. The maturity date is the finish line, when the whole thing wraps up. And finally, the issue price is what the bond first sold for, which is usually right around its face value.
All right, section 3. So if we were to look at the entire world of bonds like a consultant, we'd use what's called a MEIS framework. It's a fancy term that just means breaking things down so the categories don't overlap, but, cover everything. The whole bond market fits neatly into 4 of these categories.
So this table lays it all out for us. First, you've got corporate bonds, issued by companies. They tend to offer higher interest payments, or yields, to make up for a bit more risk. Then there are municipal bonds, or munis. These fund local projects, and the cool part is, the income is often tax-free. Third, government bonds, also known as treasuries. They're basically the gold standard for safety. And last, you have agency bonds, which come from outfits related to the government, like Fannie Mae.
Okay, now we're getting to the really interesting part. This is where the action is. We've said over and over that bonds pay a fixed income. So why do their prices seem to jump around on the market every single day? Let's unpack that.
So, yeah, this is the big question, right? It feels like a total contradiction. I mean, if the interest payment is locked in, shouldn't the price be locked in too? Well, the answer isn't about the bond itself. It's about what's happening in the world around it, and specifically how interest rates are moving.
And here's the answer. It's what I call the iron law of bonds. And you absolutely have to burn this into your brain. Bond prices move in the opposite direction of interest rates. It's that simple. When new bonds are being sold with higher rates, your older, lower-paying bond just became less attractive, so its price has to fall to compete. And of course, the reverse is true. Let's make this real with an example.
Let's make this concrete. Imagine you own a $1,000 bond, and it pays a really nice 10% coupon. That's a fixed $100 in your pocket every year. Now let's play out 2 scenarios. First, what happens if overall market rates suddenly fall, and new bonds are only paying 5%? All of a sudden, your 10% bond is the hottest ticket in town. But what if rates go the other way, and new bonds start paying 15%? Ouch! Suddenly your 10% bond doesn't look so great.
Okay, so let's take that first scenario. Rates everywhere else drop to 5%. Investors are going to flock to your bond and bid up the price. They'll keep bidding it up until its fixed $100 payment equals that new 5% market rate. Just think about the math. 5% of what number equals $100? The answer is $2,000. That's right, the market price of your bond just doubled.
Now let's look at the flip side. Market rates shoot up to 15%. To have any chance of selling your bond, you've got to offer it at a deep discount. It still pays that same $100, so its price has to fall to a point where that $100 represents a 15% return for the new buyer.
And the math on that tells us the price is about $667. Same bond, same $100 payout, but its value on the open market just got slashed by a third.
This all brings us to a super important metric. How do you actually compare that bond trading for $2,000 to the one trading for $667? You use a standard measure called yield to maturity, or YTM. It basically calculates the total annual return you'd get if you bought the bond at today's price and just held it all the way to the end. It's the great equalizer. It lets you make a true apples-to-apples comparison between any two bonds out there.
All right, let's bring this home. In our final section, we're going to talk about the investor's playbook. We'll look at the practical ways you can get into the bond market, and then we'll touch on a few, let's call them advanced variations that you're likely to come across.
So, how do you actually get your hands on these? Well, there are basically three main ways. You can buy individual bonds directly through a brokerage account, pretty much just like you'd buy a stock. For U.S. government bonds, you can even go straight to the source on the Treasury Direct website. But honestly, the most common way for most people is to invest indirectly through bond ETFs or mutual funds, which gives you a whole basket of bonds all at once.
Now for a few of those variations. First up is a zero-coupon bond. This is about as simple as it gets. You buy it for a big discount, say $700, and then it pays you absolutely nothing, no interest checks, until it matures. Then, on that final day, you get the full face value back, say $1,000. Your entire profit is just the difference between what you paid and what you got back.
Next, you've got the callable bond. Now, this one has a catch, and the catch benefits the company that issued it. It gives them the right to pay your loan back early. And when would they do that? When interest rates fall, of course, so they can borrow new money more cheaply. For you, the investor, this is a real risk. Just when your bond is at its most valuable, paying a high rate in a low-rate world, poof, the issuer can just take it away from you.
Now, a puttable bond is the exact opposite. This time, you hold the power. It gives you, the bondholder, the right to sell the bond back to the issuer before it matures. This is a fantastic feature to have if you think interest rates are about to skyrocket, which would crush your bond's price. You can just put it back to them and get your money back early. So, when you pull it all together, what have we learned? At the end of the day, bonds are the bedrock of what we call fixed income investing. They represent one of the most fundamental relationships in all of finance, the loan. When you buy a bond, you are literally lending money to massive corporations and entire governments, providing the capital that fuels the whole economy and earning a return for doing it.
You know, we always hear people talk about bonds as safe investments, the boring part of your portfolio. But safety isn't really that simple, is it? We've just seen that while the income from a bond might be fixed, the actual market value of your investment is constantly in flux. So this leaves us with a pretty important question to think about. Now that you understand this dynamic dance between price and interest rates, how does that change your view of what risk and safety really mean when you think about your own financial future?